No best time frame exists. One common question from beginning traders: which time frame is best to trade? On internet, opposite opinions. Some say trade only higher time frames, less noise there. Others claim real opportunities on lower time frames where movement's faster. In practice, both approaches can work. Problem not in time frame. Problem is trader often chooses time frame randomly. If you're following our course, subscribe to channel and check out Strifor's Telegram, daily market updates, link in description. 3 selection factors: time, psychology, strategy. Actually, time frame choice should depend on 3 things: trader's life rhythm, psychological comfort, trading strategy character. Let's break down each factor. Factor 1, time you're ready to dedicate. Time you're ready to dedicate to market. If work full day and can check chart only few times per day, will be extremely difficult to trade on minute or 5-minute charts. Lower time frames require constant presence at monitor and quick decision making. In this case, more suitable will be hourly or daily charts. If trader can actively observe market during trading session, lower time frames can give more opportunities. Factor 2, psychological comfort. Lower time frames give more signals and more trades, but together with this, they give more noise and faster movements. Not every trader feels comfortable when price can travel significant distance in few minutes. Higher time frames more calm, movements form longer, decisions made slower, and trader has more time for analysis. Factor 3, strategy character. Some strategies work better intraday, others oriented toward holding positions several days or even weeks. Important that time frame matches trading model logic. How to use multiple time frames. Let's look at example. Same instrument on several time frames. On minute or 5-minute chart market may look chaotic. Multiple oscillations, pullbacks, false movements. But if look at same instrument on hourly or daily chart, structure becomes much clearer. Levels appear, reaction zones, movement direction. This is one reason why professional traders often use multiple time frames simultaneously. For example, higher time frame helps determine overall market structure, middle, find zone of interest, lower, specify entry point. This way, market starts looking much more logical. But here, important rule, don't analyze too many time frames simultaneously. This creates information noise and can lead to contradictory signals. Usually enough 2 or 3 time frames. For example, D1 plus H1 plus M5 or H1 plus M5 plus M1 for scalping. Such approach allows seeing both big picture and entry point. Practice assignments. Practice. 2 assignments on Strifor demo account. Assignment 1, view market through 3 time frames. Open any instrument and view it on D1, H1, M5. Answer questions. Where does market structure look clearest? On which time frame easier to see levels and reaction zones? Where most noise and small fluctuations? Where easier to understand movement direction? Goal: see how market perception changes depending on chart scale. Assignment 2, determine your working time frame. Answer honestly, how much time per day can you realistically dedicate to market observation? How comfortable do you feel with fast price movements? Prefer more trades intraday or calm trading with rare entries? After this, try to determine possible time frame combination for yourself. For example, W1 plus D1 plus H1 for calm medium-term trading, D1 plus H1 plus M5 for intraday, H1 plus M5 plus M1 for active short-term trading, scalping. Goal: choose not just time frame, but comfortable trading style you can maintain consistently. What's next? Let's sum up. No best time frame exists. Only that time frame which fits your trading style, matches your strategy, and fits your life rhythm. When time frame chosen correctly, analysis becomes simpler and decisions more consistent. Write in comments, which time frame do you trade now? Feel psychological comfort or have desire to try different scale? Next session, we'll cover another important question. How many trades should trader make and why too frequent trading often becomes cause of losses? Don't miss it.